So you are ready to raise capital. And as a founder, the timing feels right. You've actually built some momentum, you've gained some sales traction, and investors are starting to show some genuine interest in your technology. The investor conversations are encouraging, they're asking the right questions, they're showing some serious intent in your company, and you're starting to explore what a good deal may look like, how much they're going to invest in your company, and how much of your company that they'll own in return. It sounds promising, but how do you know if it's fair? And what's the industry benchmark for equity ownership at the early stage of your company? Welcome to Tech Uncensored. My name is Hessie Jones. And the truth is, there's no real handbook for negotiating with investors in a way that protects both your startup and sets you up for real growth. Many early stage startups begin building these relationships with strategic advisors. These are individuals who will offer guidance for the startup without actually writing a check. Over time, they may build trust, and they have these early supporters who become champions of the company. They'll eventually invest, they'll open doors to partners, clients, and even future investors. But landing that first lead investor is not easy. It's a daunting process. So, what does a strong investor relationship actually look like? What red flags should you watch out for? And how do you know when you've negotiated the right terms that are right for your company? Bringing on an investor is like the beginning of this long term relationship. It's a business marriage, and it takes consistent communication. There needs to be transparency in that communication, and there has to be a willingness to have some of these difficult conversations. Your investor is going to want regular updates. They want to assess your performance over time. They'll challenge many of the decisions that you make and push you maybe in directions you hadn't even planned on going. So these relationships will build and shape how you achieve those results and how much these investors will influence your journey along the way. So today I'm pleased to welcome Ben Su, who is the co-founder of Capita.io, the first AI-powered lawyer. And Ben joined us previously to discuss automation and the future of legal services. As a lawyer and co-founder who's raised capital himself, he brings in this unique perspective in navigating investor dynamics. So he understands how critical it is for founders to understand some of these signals and decode some of these motivations behind the investor behavior. So we're going to explore together the investor mindset. What are they really looking for? What does success look like for an investor? How does a founder negotiate value and choose the right investment vehicle at their stage? And then we're going to talk about term sheets, because this is something that many founders don't know a lot deeply about. And what are the things that you should be looking for when it comes to these legal agreements? And then finally, we're going to tackle the importance of a healthy founder-investor relationship. So that's a lot to talk about. Welcome, Ben.
Thank you, Hessie. Happy to join.
This is a great topic because I've been receiving a lot of questions from founders every time there is a critical conversation with a potentially new investor or a new advisor or a new co-founder. It always delves into what is good for me and legally what can I do. So let's start off with you and your background. As someone who went to law school and now you're a startup founder, please take us through that journey and how that's kind of shaped where you are today.
Yeah, absolutely. So I was actually a startup founder before I went to law school. For brief, I started a biotech company in the last year of my undergrad. I was studying biochemistry and I got into the biotech world. And yeah, I got to work on male infertility diagnostics. I got to see the whole process of, licensing the patent to a pharma and then getting some exit out of it. And then I went to law school precisely because of that founder experience. I hated having to deal with the legal black box and the complexity associated with legal. So that's why I chose to go to law school. One of the reasons why I chose to go to law school. Yeah, and after law school, I worked in house in startups, big and small. The biggest startup I worked with was a New York Stock Exchange listed company that manufactures about a couple hundred thousands of electric vehicles and develops full self driving technology. Um, yeah, uh, and also I sat on both investor side and founder side in terms of venture financing deals. So I got to see, the different objectives or the similar objectives from both sides of the negotiation table. So that kind of like opened up my worldview in terms of the unique role that uh, lawyers play in the venture technology world, which led me to co-found Capita. We're trying to reinvent the legal services industry for startup entrepreneurs using technologies like AI.
Okay, so you sent me a little story about yourself earlier. You had a bit of a run in with the law, and that has really shaped your thinking. Can you tell us a little bit about that?
Yeah, absolutely. So I was unlawfully detained by the Toronto Police Service, and it went on. The whole thing went on for another additional 2 years of malicious prosecution. Eventually, all the charges were withdrawn by the Crown prosecutors 30 seconds into the trial. Uh, in the whole interaction with the police, I never once mentioned I was a lawyer because I was actually curious. Like I read about all these things that happen on the news article. I want to see if it's real. And also at the same time, like I had experiences representing clients at the Human Rights Tribunal. Uh, I was a national award winner for my critique on the Supreme Court's decision on the Charter of Rights and Freedom. So yeah, like I wanted to see as like kind of like a hobby. I wanted to find out about where the police could take this, and surprisingly, the news articles were true, and 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 I think it provided me some unique perspective on this in a way that if it wasn't without if I didn't have access to the premium subscription of ChatGPT, Gemini, and DeepSeek, I would not have gotten out of the situation I found myself in.
Now, can
Yeah.
I ask, even without that, you've already had the skills of a lawyer. So understanding what the process was, what documents you need to access for somebody who is in your exact same situation but doesn't have that legal background, they're already at a loss. And the outcomes would have been different.
Yeah, absolutely. And I would say my outcome would have been different. Even if I was even though I am a lawyer, and the outcome would be different if I didn't have access to AI. The reason is because I didn't have the time to dig through the jurisprudence and draft all of these you know uh, documents for judges to see, right? And AI essentially made it possible for me to uh, look in the jurisprudence, formulate a legal argument, and even design a legal strategy to navigate through this whole mess, right? And I actually published an article on Law 360 saying that when the system came for me, my co-counsel was AI, and
Mm.
if I were to kind of like make an example or analogy that resonates with the tech world, it's like, you're an awesome Google engineer, but it doesn't mean you're good at building an app for your family to use to
Mhm.
allocate chores, for example. But with AI, maybe in 20 minutes, the AI can spit out the codes for you and give you a usable product. And that's what AI did for me. In 20 minutes, I was able to interact with the AI and actually draft the application at the Human Rights Tribunal against the Toronto Police. And the caveat is that I am legally trained. I am knowledgeable about the constitutional law, about the human rights law. I was able to see some of the hallucination that people talk about in AI. I don't think AI is usable by a regular consumer yet to, you know, uh, replace lawyer at this stage. But I do think like the unique position I was in, I was a lawyer. I know about the constitutional law. I was able to use AI as an amplifier of my power.
Mhm. Okay. I would say, and because of this unique experience, there are people, let's say startup founders, who may actually go to some of these LLMs, or sorry, agentic technologies, I think, as they call now, and ask these questions, but not necessarily know whether or not that's the right question to ask. And so that's why I say you have a unique perspective on it. So that leads me to the next question, because I would say that there isn't a balance right now between startup founders and investors at the outset when it comes to negotiation. We know that this power balance imbalance favors the investor, and you as a founder may see capital, will see capital as a way to achieve growth for your company, but investors see it very differently. And because they take a look at it from a risk perspective, and they will only really invest if they see some certain signals that allow them to know that they're probably going to get some good outsized returns within 5 to 7 years. So tell me about some of the circumstances in those early discussions with investors and founders, and the moments when startups don't really have the knowledge to go head to head with investors.
Yeah, absolutely. So I think like everything else in the legal industry, the black box of the knowledge of law can be weaponized against people who don't have resources, especially financial resources, by those who do have resources. You're seeing that in criminal law context, and you're seeing certainly in corporate legal context when a predatory, investor try to enforce predatory terms on a founder who's just fresh out of college or university, right? So we see quite a bit of those phenomenons going on in the tech world. And sometimes in Canada, I would say we're very polite people. We don't like to call people out. But, when you're not calling people out, you're being silent on these predatory practices that new first-time founders will find themselves in. And the most typical predatory practices that we're seeing is, for example, incubators will ask equity stakes in the companies by overly inflating the value of their incubation service. For example, some incubator would say, hey, by joining our incubation program, you recognize the value of this service is to be $400,000, which can be converted into your equity, into the equity of your company based on the safe that we're also writing you. But the safe is only a $25,000 check. So you see a lot of these predatory practices going on. And precisely that's one of the reasons that I wanted to co-found Capita, is I wanted to de-weaponize the complexity of the legal black box for the startup entrepreneurs.
Okay. This is good, because like a lot of the things that you're talking about, we're probably going to get into a little bit more the details when we talk about the red flags. But let's start with the earliest point at the startup journey where you're forming a company, and you could maybe be at, let's say, the third or fourth month, and you have a co-founder relationship. You're bringing in potentially new advisors, and you're having discussions with vendors and partners. So you're going to have to enter into legal contracts with each of these entities, right? Advisors may ask for equity in exchange for time that they spend with you. Your co-founder, who will be putting in sweat equity, what does that mean in terms of how and when does he get compensated, and at what rate does he own the company? And same thing with vendors, especially in the beginning when you require specific, let's say, components or services that they have to offer. What are some of the things? What does it look like in the beginning when you're entering into these types of specific discussions that actually, I think for founders, they're starting to learn about, how to grow their company effectively to protect themselves and protect the company.
Yeah, the way you build a startup is very similar to how you play a game of chess. You can't just think about what the next step will look like. You have to think about maybe the next 3, 4, 5 steps, right? And in this scenario, when you're just founding your company in the early days, you have to think about, well, 6 months ahead of our schedule, where we would be. And if we're raising a round, how do we put ourselves in a position of success? And this is where the alignment of interest of investors and startup founders come in. For example, investors know that 65% of startup failures are due to co-founder relationship breakdown, right? So the simplest thing you can de-risk for your investor is to make sure that doesn't happen. And one of the ways to make sure that it doesn't happen is you have a Silicon Valley VC compliance style co-founder shareholder agreement, which addresses the scenario that would take place if you guys cannot agree on how you should run the company, right? So I'd say that's one thing that they need to consider in the beginning. And also,
Can I ask what a Silicon style shareholder agreement looks like?
yeah, that's a great question. So we actually took over quite a bit of a startup users from the big Bay Street law firms. And big Bay Street law firms, because they're quite generalized, some of them, although, you hear them as like this one of the seven sisters of the oldest Canadian law firms, but they don't have, I would say, a specialized venture and technology practice. So typically what it will look like is, in comparison to your traditional brick and mortar business, 99% of the value that the startup is generating is in the future of the company, right? I would say even for Capita, we've been around for 3 years now. We raised a round backed by some neat VCs in the US. And I would say 99.9% of the value of Capita is to be realized probably 5 years from now, right? So now that with that in mind, how you're drafting the shareholder agreement, how you're structuring the equity, the incentives for the founders, for the advisors, and for the early employees can be quite different, right? So one of the most common things that we're seeing that a Silicon Valley style startup will have that a restaurant down the road wouldn't have will be this thing called founder reverse vesting, right? So what that is that, hey, if a co-founder leaves the company before the company hit a certain stage, then there needs to be a mechanism for the company to repurchase the shares of the co-founder that's leaving. The reason you want that is because you don't want debt weight on your cap table, especially when 99.9% of value is to be realized, is to be built in the future. It would not be fair for the early employees, the founders that are remaining on the board. And your investor will come in and say, hey, look, what's this person holding 30% of shares in your company and they're doing nothing, right? So that's a very practical example of how Silicon Valley style startups are different from a corporate law perspective in comparison to your traditional brick and mortar business.
Okay, so what about vendors? So you as a startup may have other parts of your business that will fulfill, let's say, an end-to-end service that you're offering to your clients. I think one of the things that I've heard from some companies is try to diversify your vendor base, the services that you offer, so that you're not beholden to one vendor should anything ever happen. Is there something in your legal agreements that you should write in so you don't get stuck or on the wrong side when push comes to shove?
Yeah, so I think this question is most relevant for the first-time founders, who are, I would say, most likely to become victims of predatory terms from vendors. So in the startup world, the most common scenario I would say would be a vendor that's providing, contract development services to build the technology for that startup, right? And yeah, like because the first time founders, their negotiation knowledge and power are not on I would say, the market standard. So the vendors try to get away with a lot of things, especially in terms of like exclusive ownership of the IP. And it's a common practice in the software development world where if I build a tech for this client and the client uses that to run their app, now, another similar startup comes down the road in my pipeline, I can repurpose a lot of the codes that I already wrote for that startup client, right? So that's kind of like the downside of having an external vendor to build your technology for you in an early stage. And to be honest, I think there's not much that a lawyer can do to improve that experience, but rather it's about letting the founders know that, hey, look, when you're about to go raise a round, the lawyers on your VC's team, they're gonna have to look at your IP assignment. They're gonna have to look at, who's do you have any vulnerabilities or potential disputes that could arise with the technology that you already built, right? So I think those are some of the considerations that early stage founders need to realize.
Okay, so let's dive into the legal agreements that a founder will get into as they develop some of the foundations of their relationships with investors, right? You are now a founder that's ready to have serious discussions about investing, and some early stage founders, and you mentioned this earlier, they're looking to lead investors and may look at safes as an expedient way to get investment without valuation. So I want you to explain what a safe is and why, and what do investors think of safes in general, and why does it favor the investor or the founder?
Right. So I actually have quite a bit of insights to share about this because when we raised our recent round, we raised from this angel network that is probably the biggest angel network in Canada in terms of deal volume on an annual basis. And we were their first safe investment in history. Uh, so the reason why I want to bring this up is that I think there's a lot of a misunderstanding about safes in the Canadian venture investment market. The reason is because, first of all, safe simple agreement for future equity was this new investment instrument that was invented by Paul Graham at YC. The idea is, when in the typical YC type of investment strategy, uh, you are investing in 100 companies, and based on the power law return formula of venture capital, 10 of those 100 companies will generate the entire return of your investment fund, right? And that's how your typical Silicon Valley venture capital work. Now in Canada, because there are quite a bit of our angel investors or members of the angel investor community, they've never become a part of that journey, right? Either on the startup side as an early employee or founder, or an investor that invested in a typical, YC company, right? So what the end result is, investors feel unsafe, pun intended, when they're asked to invest in a safe round. Uh, and the reason is because of the uncertainties that they have, right? Or I would say the lack of understanding of the legal instrument. I think first thing that the investors need to know is that, yes, you prefer to invest in a seed share purchase agreement. Yeah, like you would have a lot of like the corporate law legislation protected shareholder rights that a typical safe holder or safe investor wouldn't have. But the problem that with that logical reasoning is that you're not investing in a traditional business. You're investing in a startup that generates power law type of return for a venture capital investor. And typically, these startups, the outcome can be binary, meaning it's a zero or it's a lottery ticket type of winning, right? So if you try to invest in a company through a share purchase agreement, and the company say, they have A16Z or YC on the cap table, you will never, ever be able to participate in those opportunities. That's number one. And number two is the investors don't know that SAFE actually has this anti-dilutive effect, especially with the valuation cap SAFE. So what a valuation cap SAFE is, you can think of it as a call option. I gave you $1 million, you as a startup, for the right to convert that $1 million into equity in your company when some event happens. Usually it's when you go out and raise a price round. Now, the conversion formula would be, I get to convert equity into your company at a price of no more than, typically for a pre-seed company, it would be $5 to $10 million, right? So you have a maximum conversion amount. This means that even if the startups went out to issue or dilute additional shares to bring on super talented engineers, your valuation cap stays constant. So that provides some sort of like anti-dilutive effect. That's number one. And number two is that in a typical high growth startup in this early stage, it's very typical for the startup to pivot, right? And if you're investing in a share purchase agreement, you have even like a seat on the board, you're taking away the agility of the company to make pivots, right? Yeah. And because we're not going to do a shareholder vote and get a resolution to pivot from a B2B SaaS company into a B2C SaaS company, right? Startups need to move fast and break things. So I am anti investing in startups using share purchase agreements or typical price round before the startup hit Series A. And the Carta data shows that. I don't know if you get to edit this, but like if you pull up the graph from Carta, I think it shows that more than 70% or like 90% of pre-seed rounds in the States are done through a SAFE, right? And there's a reason behind that. It's not simply just like, oh, it's a founder-friendly instrument. No, it has some like investor-friendly features built in as well.
Okay. I want to just straight up ask you, this is a question that somebody had asked me. He is a company that's developing this amazing technology, and potential investor said, I love it. I want to go in early. He hasn't gotten any revenue yet. The concept is there, but it's not a working prototype as of yet. So he wants to invest $500,000 for 30% of the company. What's your take on this? What should he do?
I think like, $500,000 is quite a meaningful amount of money. And it would be quite ludicrous for many founders to turn it down. But the catch is that the 30% equity is a catch. The reason why I'm saying that is to scale a company from pre-revenue to, say, a unicorn stage company that generates $1 billion in annual recurring revenue, you might have to go with several rounds of financing down the road. And no disrespect, but the person that's offering this type of deal, $500K for 30% equity, it signals to me that the investor is actually not sophisticated venture technology investor, right? And if you have someone only that type of, the reason why I'm saying they're not sophisticated, because it's just simply not the type of, it doesn't make a sense. It doesn't make a lot of sense for, A16Z or YC to do that type of deal, right? And it's very deviated from the market standard. Now, the risk that the investor is creating for himself and for the startup entrepreneur is that later on the technology does well, you have some like super great early tractions, and you go to Silicon Valley, you talk to Initialized Capital, you talk to A16Z, and they're saying, oh, who is this Joe Schmo on this cap table that's holding 30% of your company? What do they know about this technology? And so it means like I have to deal with this person that may be in the way, or that has a capacity to be in the way in terms of deciding how the company should be run. So that creates more, I would say, downside risk than upside incentive in that type of deal. Is that your cap table is going to be a huge factor in terms of convincing the super sophisticated, the super capable, the super powerful venture capital investors that could really bring your company to the next level. And if someone, and the founder needs to know that if someone's willing to write a check, he's not the only person that will be willing to write a check in this world. You can go shop around. There's no law that says you can only take $500,000 from individual ABC. I think if you're building a compelling technology that solves a genuine problem, then there's many options out there that could give you a better deal.
Yeah. Now, but let's assume that this guy comes in and he's the very first person that you talk to. And you know what they say, a bird in hand is worth two in the bush. So the other thing that the founder doesn't really understand at this point yet is how this affects dilution down the road. And you've talked about a little bit about it, but now that we have a concrete example, he wants 30% of your company, $500,000. What does this mean to the founder ownership over time?
Right. So it creates unnecessary dilution in the beginning. The reason is because if you look at the long-term perspective of the company, I think it's ideal for the founders to work towards owning 50% of equity in the company when they raise a Series A. Right now, when you're already giving 30% away before the technology even hit the market, before the technology even demonstrate any traction, you don't have much room left to play with, right, on your cap table. And I think that if you take a look at the annual statistics from Carta, that 500K for 30%, like that is not market standard. And I would say to that founder, go back to the investor and ask the investor to justify why should you get the non-market standard of treatment. Because there's this misconception in the Canadian startup world that you need to hit whatever ARR or MLR in order to raise your first 500K. That cannot be further from the truth. I don't have to offer an anecdotal example of Capita because we did raise our first $1 million with no product, with no revenue. But it's actually common for founders to go out and raise from venture capital investors on the concept of founder problem fit. For example, the managing director at Costa Ventures, Keith Rabot, he actually mentioned, unlike growth stage company investing, where like financial metrics play an important role, in pre-seed, seed stage, and early stage investing, it's more about a vibe check, right? Are you the right type of founder solving the problem that you're working on? Because because even if you have the most amazing idea, the most amazing business plan, no plan survive after the first contact with the enemy. So you're gonna have to pivot. You're gonna have to use the data input that you're gonna collect to change your strategy, to adapt, right? So my advice to that founder is, like, there are great options out there for you to choose, and you're not limited to just that one investor or to that one angel network in your city.
Okay, that's great. That's great. That's good to know. I think that if somebody is already showing interest, then you know that you have something, right? And you
Exactly.
don't have to put all your eggs in one basket. So let's talk about the term sheet, because this is where a lot of that negotiation may happen. First of all, tell me a little bit about it, like what's included in it, and whether or not it's a binding document.
Well, typically term sheets are not binding. It basically spells out, the general terms that the investor will invest in your company with. Typically it's the check size and the type of valuation cap, or if it's a price round, the type of equity, the percentage of equity that they're looking for, right? And sometimes in I would say a very formal venture capital investment round, the lead investor would put on other terms in a term sheet. For example, uh, it requires all the other investors to follow the rules that the lead investors has designed, right? So the investors writing smaller checks, they don't get to have a say. The reason is because they're not writing $1 million check. They don't
Okay.
have the negotiation power, right? So term sheet usually is non-binding, and what founders, I'm not saying that this is what founders should do, but what a lot of founders do is they use a term sheet they get from one VC to leverage against the other VCs. Now, you have to do it in a totally, I would say, ethical way, because if someone's showing love to you in the early days, right, you have to show them love back. So, but I have seen founders just using term sheets to shop around, but hey, they know what they're playing with. Sometimes, reputation matters more to some people than other people. That's all I have to say about that.
Okay. So sometimes people put stuff into term sheets that are questionable, and I want to get into some of those red flags that founders need to be aware of when they're actually reviewing the term sheet. Can you talk about some of those red flags?
Right. So in the super early stage of deals, some of the red flags that we're seeing is, for example, an accelerator that's writing a $25,000 check or $100,000 check, and they would ask the founder to recognize the incubation service that they're giving to the startup as an in-kind contribution that could be valued at $450,000, right? So they would say, hey, here's a $25,000 check for safe investment. Valuation cap will be $5 million. But you're also recognizing that the incubation service is costing has a fair market value of $450,000. So in the end, their safe investment amount, the purchase amount in the safe, would not be just 25,000. It would be 25,000 plus 450,000, right? So that's one of the most typical red flags that we're seeing coming from the incubators.
Mhm. Can
In
I
terms
just
of,
say, I just want to say that Altitude Accelerator does not take equity for any of the programs that we offer, and nor will we in the future. So that's an important
yeah,
caveat.
yeah, I think that's a way to do it. And also, uh, there are other red flags in terms of incubators giving out services or access to resources, and they will ask in return for 2.5% warrant to convert, their service fair market value into equity in the company. Right now, the catch here is that uh, the conversion would take place at a price round. So if you're a typical startup following the trajectory of a Silicon Valley style financing round, that 2.5% gets converted at Series A. So what that means is that for the desk that they're offering you, for the free coffee that they're offering you at the office, they get to have 2.5% at Series A. Now, I'm not saying like that's a bad deal. It is a bad deal, but more importantly, that would signal to your future investors that you lack the judgment skill of running a company that they're investing in. To be honest, like if I was an investor, I would ask the founder, why did you make that decision? For some free coffee, for some free desk, so that someone can own your company for 2.5%, and then they don't get diluted in your early safe and convertible rounds, right? For what? So I would caution founders with a following statement. You're going to have that conversation with your lead investor sometime down the road when you're raising the round. So you got to be able to justify your choices so that, you know, people can actually trust you with their money to run the company that they're investing in.
Okay, so there's some other things I want you to talk about. Like in some term sheets, I've seen things like excessive control provisions, and this is where if you are an investor and you want, for example, to have a say in who gets hired, who gets a board seat, even approval of the budget, is that is a red flag, correct?
Absolutely. And I would say sometimes these terms are probably mandated by the investor themselves, and sometimes it's probably mandated by the lawyer of the investor, right? Because the typical incentive structure for a lawyer is that the lawyer doesn't care if the investor makes 100x return on this company. They care that, hey, look, Mr. Investor, Mr. Client, I'm doing all these wonderful things for you, getting you all these investor rights. But there's no punishment for the lawyers if those investor rights are at the expense of the future success of the company.
Mm-hmm. Mm-hmm.
Right. Okay. So I think like those terms and conditions that seemingly on the surface is protecting the investors could actually destroy a company, simply because, like I said, 99% of a startup's value creation is to be done in the future. And that means you need to be agile. That means you need to be flexible. That means you need to make the best judgment. And sometimes the judgment could be anti-common sense, right? And if you have to navigate through the shareholder votes for the budget approval or the board approval for the, you know, the pivot that you're about to do, you're never going to make it. And I think the message for the investors is that, you know, protecting your whatever 10% of a small pie may sometimes may turn that small pie into a $0 value pie, right? So you're better off to let the experts sit in the driver's seat and they take the car to the best possible direction, and you get to just like, you know, strap down for the ride.
Yeah. Yeah.
Because in the beginning, the question is, if you cannot trust the founder to make good decisions and you have to step in to substitute their decision-making rights, you're probably investing in the wrong person.
Absolutely. And from a founder perspective, you obviously have the wrong person who wants more control, who wants more certainty. And so I just want to mention a couple of other things that could be red flags. They could ask for unrealistic deadlines, unrealistic milestones. They may want you to report more often. And this actually constrains the time of the founder, who will spend more time trying to appease the investor as opposed to putting time in the company, as you were talking about.
Yes. And I think like that's a signal that the investor has never participated in a legitimate venture capital investment round. That's a signal that the investor doesn't know anything about venture capital companies. And that's a signal for the founder to stay away from that investor, because they will only create friction for you. Because when you're raising capital, it's not just like raising money. It's more about the access to the resources, to the knowledge, to the expertise that the investor can bring to the table. And capital, we had the benefit of not only getting investments, but also getting investments from people who sold their companies to Facebook for $150 million. So we can call them and say, hey, look, like we're running into this problem. What was your experience like? What would you do if you're in the founder seat? So those people, they would never ask for a board seat. They would never ask for milestone deadlines, whatever information rights or reporting requirements or auditing requirements. They just say, hey, just go build. This is going to be a binary outcome. You either make me super rich or you turn my investment into nothing. And I'm totally okay with that.
Okay. Okay. So let's dive down into the term sheet. Because when it comes to valuation, this is the point of contention for many founders, because there is no real, I guess, it could be a gut check in the beginning to understand what your valuation is. What are the, I wouldn't say standard, but what are the types of methodologies that investors may use to determine the value of a company, and what should founders look out for when they're presented with a, hey, your company is worth $50,000 at this stage? What does that really mean in terms of how did we get to that number?
Yeah, great question. Well, like Warren Buffett says, hey, the best way to value a company is based on the discount cash flow model. But the problem with early stage startups is that many of them are probably pre-revenue. So the traditional finance sector DCF model does not work, right? Like one of the things that I think just like makes absolutely no logical sense to me would be investors requiring a pre-revenue startup to do a financial projection. Well, typically, if you're an accountant, your financial projection would need to be based on past historical performances, right? And so you would need to have some factual foundation to project this is the amount of revenue we're looking at 2 years down the road. But when I go to these pitch competitions, I see all these startups putting up a slide. Oh yeah, we generated $0 so far, but we're looking at generating $5 million ARR in 2 years. That is not based on reason. That is not based on facts. That is not based on the whole financial sector's guidelines, right? But sadly, that's what you see a lot of these pitch competitions. So how do startups get valued? In my opinion, well, investors make decisions based on the founder problem fit of an early stage startup, right? Many Silicon Valley startups, they don't even have a single dollar of transaction when they raise a couple $1 million, right? And I'm not saying that's an anecdote. I'm saying that is a norm, right? Maybe it's not a norm in Canada, but in Silicon Valley, it's not uncommon for Jason Calacanis to write a whatever $25,000 check that he writes through Launch Fund to a bunch of college students that are pre-YC, right? Mm-hmm. So I think the way I've seen investors valuing company is they go on, they use a market standard. You know, if you're a pre-revenue SaaS company or fintech company, the industry standard is $5 to $10 million of valuation cap in a safe, and it's not based on financial metrics, but it's more based on this is what everybody else is doing, and therefore that's what we're doing. Now, there's some reasoning behind that. Is because the market determines the final price tag of anything that you ever buy, either being equity in a company or this cup of coffee, right? It's just like if you're offering lower valuation, then the founder can go somewhere else, and some other participants in the market will write a check. So I think in the early stage of a startup, the founder needs to subscribe to Carta's annual reports, just because Carta manages the cap table of these companies. They have first-hand insights into a company that's in your stage, what type of terms that they're raising on, what type of valuation they're raising on, how much they're raising.
Okay. That's cool. I think the other thing, and you mentioned this earlier, if you could just talk a little bit about some of these anti-dilution terms and how that could be problematic for the founder.
Yeah. So I think in the early stage, the most anti-dilution terms that we're seeing from the investor side is, they ask for share warrants that could be converted at a qualified financing round. Okay. It's
Okay.
very common for accelerators, incubators. I know Altitude doesn't do it, love it. But a lot of accelerators, what they do is they say to the founders that in order for you to be a part of our program and receive our service, you agree to give us 2.5% in your company when you raise a qualified financing round. Now, you read through the pages in the document and you look for the definition of a qualified financing round. So a qualified financing round would be you're raising a price round, meaning like, you're issuing shares at a certain price for your investor, and you're raising sometimes it's $250K to $1 million. Now, the problem with that is if you're following the typical trajectory of a Silicon Valley startup, your first pre-seed and seed are raised on safes and convertibles, right? Those investments would convert based on their valuation cap or whatever discount rate that you're offering. But the 2.5% that you agree to the accelerator, they don't get the dilution that you would get as a founder, right? So they're asking for 2.5% at the qualified financing round. Typically, it's a Series A round. And
Can I ask if they had it, let's say that there wasn't any anti-dilution term, what would that 2.5% look like at that time if they weren't to anti-dilute?
yeah, well, so that would look like well, you would need the specific numbers in order to look at like
Yeah.
how that 2.5% would be diluted. But what I can tell you for fact is that 2.5% will be diluted just like everyone else's shares in the company, just like the employees, the founders, the early investors, right? Or the advisors. But hey, just because they had that share warrant that's exercisable at a qualified financing round, they get to skip all of that dilution.
Yeah. So that's something to definitely look for when in the term sheet. Okay. Let's move to a post that I actually saw on LinkedIn, and I sent this to you. And this is a scenario where you are an employee that actually works for a new startup company. You took a pay cut as, let's say, a head of product at the company, but you are also getting a 1% equity in in favor of that pay cut. So what does that 1% equity mean to you as an employee as you move through the growth of the company, especially when you get a $2 million initial injection from an investor? How does that impact you? Let's assume 5 years down the road when there is some kind of liquidation event.
Yeah, absolutely. So I think the way I like to look at this question is when you make the decision of leaving your $500,000 salary at Google to work for a scrappy little startup, that decision needs to be a disciplined decision, and it needs to you need to think like a venture capital investor, because you're actually making an investment, right? The opportunity cost, I would argue that's an investment, right? So a typical venture capital investor, they think in the following, they think about their scenarios in the following three ways. Scenario number one, this company goes to zero. Every dollar they put in becomes zero. Scenario number two, this becomes an outsized, unicorn type of return. And they get to write a LinkedIn and Twitter post to congratulate themselves for hitting that jackpot. And scenario number 3 is it becomes a mediocre return. Like, yeah, you're doing exactly like a private equity type of company. You're generating S&P 500 type of annualized 15% return, right? But the problem with option number 3 is that when startups go out and raise capital, especially in Series A, Series B stages, it's not atypical, or I should say in normal human words, it's common for VCs to get liquidation preference. Sometimes it's like, what that means is that, hey, in order for anyone on the cap table to be paid, I have to be paid 2 times of the input of the money that I gave you, right? So, so you have to think about that type of sophisticated investors being on the cap table as well, to factoring in your reward calculation as an employee, as an early stage employee who gave up a super awesome salary at AWS to work for a startup. Mm-hmm. So I think what these engineers or talents need to think is they need to think like a venture capital investor when they make this type of decision. They need to think that this needs to be a type of return that generates 100x in value creation. If not, it's a write-off in their book, because that's what our VCs told us. The VCs expect every single check that they're writing in a startup to return the whole fund. So for example, you're a $100 million fund, a mid-sized VC in Boston, and you're writing $1 million check to the early stage company. You will want everything. So when you make the investment decision, you're calculating that this company would turn that $1 million for me into $100 million, right? Anything less than that, it's a write-off. That's just like the typical venture capital power law return model.
Right.
And
so that
employees need to think that. Yeah.
Okay. So that when we translate that into the perspective of that employee, the reality means that he probably will not get anything for that 1% equity. Is that right?
If it's a mediocre return, they'd probably be better off just work at Manulife as a data scientist and then put their Manulife salary on the S&P 500.
Okay. So he's probably taking just as much risk. The good side about this is that he's actually at least earning some salary, even though it's much below, let's say, the market rate. But from that perspective, realistically, he will not get anything out of it.
Yeah, correct. Okay. And I do say that there are these hidden black boxes that sophisticated venture investors would know. And I think like this type of information needs to be democratized widely to the industry, so people know what they're getting themselves into.
Yeah, I agree with that. And I think that's why I wanted to have this session with you, because I find that there is so much power imbalance here that the startups themselves are kind of flying blindly. And unless they actually are, I don't know, they're lucky to have access to some of those conversations with startups that actually have made it, and they can give them some sage advice. A lot of it is like, how do I know if what I'm being told is actually truthful or fair? So that gets me to the next question, is that throughout this whole process, once you engage with the investor, once they're all in, and let's say 3 to 5 years later, in that whole process, you're going to have to make sure that you have like sound legal counsel, and they're going to be pivotal in how you grow as a company. So tell me about what that looks like in terms of even finding like the right legal services for you to ensure that you're being protected in the growth of your company.
Yeah. I mean, I'm going to try my hardest not to make this a sales pitch about Capita, because that's like the whole premise that we built our company on, is that we call this founder empathy of a lawyer. It's because if you never had to, as a lawyer, if you never had to sit in the driver's seat of going out and raise a seat round, if you never had to go out and negotiate and try to push your way into a venture capital's portfolio, it's very difficult for you to understand some of the things that need to take place ahead of those scenarios, right? And so the reality of the matter is that there's a lot of perceived value assigned to the big Bay Street law firms by the startup founders, or even by, like, say, like the experts, the investors in the startup world. The problem is that when you're an early stage company, when you become a client of a typical Bay Street law firm, you get staffed with a first year, second year, third year associates. Now, these associates never got to see what a Series A round would look like. They never got to participate in the negotiation stage of a $10 million venture capital investment deal, right? So I'll give you a typical example. We actually the best conversion of our customer, meaning like the best way for us to sell a customer, is we find a customer that's already paying a Bay Street law firm. So this is my typical pitch to them, is that I know you're a fintech company, but you do know that the convertible note, the convertible debt that you raise your pre-seed seed round with, say the $5 million in convertible note that you raised, it could be problematic to you when you're selling your product to the big banks. The reason is because banks will look at your debt equity ratio, and in the generally accepted accounting principles, convertible notes sit on your balance sheet as a debt. Safe doesn't. Safe sits on your balance sheet as an asset, like as an equity, right? Like it doesn't sit. It's not a debt because you don't have to pay that amount back. Even though convertible notes never get paid back to the investors, they almost always end up getting converted into the startup's equity. But the bank doesn't care about that. They're saying, hey, in order for me to purchase your product, I'm a big bank. I'm CIBC, I'm RBC. Your debt equity ratio needs to be at this. But your convertible note, every single dollar you ever raise was through a convertible note. That would actually keep your startup out of the vendor list of a lot of these financial institutions, because these financial institutions are looking for longevity of their vendors. If you're not going to be around because you have a high debt equity ratio, we can do business with you. So that's type of like knowledge that many Bay Street lawyers don't have. Is the type of the Bay Street lawyer that would have that knowledge, they would be a partner working exclusively with like super late stage companies, right? Companies that, or even growth stage companies that raise, $100 million. They will have that knowledge. But the first year, second year, third year associate working at a fancy Bay Street law firm, they would never have that knowledge, right?
Yeah.
So I think in terms of choosing legal counsel, it's like the person has to. So my mentor, who's a big tech lawyer in Waterloo, worked at Miller Thompson, worked at Gowling. He worked at Silicon Valley for 10 years. So he taught me a lot of those things that I learned. And I would say to choose a legal counsel, I would go with that type of lawyer or Capita for that matter.
Yeah. Nice plug. Okay. Okay. So last question for you. What does an optimal investor founder relationship look like over the course of 5-7 years? If you were to say, this is the type of a relationship that I have, that I want to have, so that it gets me to my growth goals, but at the same time creates an environment that makes me feel comfortable with this relationship?
That's a great question. So I actually listened to like an interview for I think his name is Daniel Eberhard. He's the founder of Coho Pay. So he's also a portfolio founder of Drive Capital. Drive Capital also invests in Capita. So he brought up this story that Chris Olsen, who's the founder of Drive Capital, sits on Coho's board of directors, right? And Daniel told this story that, Chris had a huge disagreement with Daniel. And Chris said to Daniel that, hey, listen, ultimately, you are the CEO, you are the founder of the company. I disagree with you, but when you're wrong, I'm not going to tell you that I told you so. Right. So I think it's that, like, that's a type of, I would say, personality and wisdom that founders should look for in investors that they're onboarding, so that, you know, the ongoing relationship can be built on trust and mutual respect. Right. And some of the questions I get asked uh, by some accelerator program in downtown Toronto, their question was, how coachable are you? Well, I'd say, hey, look, I wouldn't be here if I didn't listen to the advice of my mentors or my investors, right? But also, I wouldn't be here if I listened to every single advice from the so-called experts, the consultants, the lawyers. So I think at the end of the day, the relationship needs to be like, hey, the founder's in the driver's seat. The best you can do is to make available of the insights, experience that you have, because you had that experience. Make that available, accessible to the founder. And the founder also, one of the things that we're super disciplined about is every single month, Capita will always write an investor update to our cap table investors. We'll tell them the wins of this month, the losses of the month, and what we learned from this month. And sometimes we have an ask session saying, hey, we're looking for help on this side. And sometimes we don't. But we're super vulnerable. We're super transparent in terms of the things that we share in our monthly investor updates with our cap table investors. And sometimes they're super awesome people. I have a philosophy that people become successful because they're kind. Most people become successful because they're kind, because kind people like to help kind people. You don't become successful by being a jerk, right? So we benefit a lot from the kindness of people on our cap table, as well as people that never made it to our cap table. You know, one of the partners, I want to mention his name because I have only good thing to say about him. His name is Kevin Medill. He was a founding CTO, co-founder of Mile Vision, and he's a partner at Graphite Ventures. We often go for walks with Kevin in Ottawa. And Kevin gives us super awesome insights about, you know, what you should think as a founders. Often he tells us, hey, I'm going to put my founder hat on. This is what I'm going to tell you. Now I'm going to put my VC hat on. This is what I'm going to tell you. And so that's a relationship that we have with our cap table investor, as well as people who are not on our cap table.
That's great. You know, I think the one thing that I'm learning just from our conversation is that founders do have choices. They don't have to accept what's in front of them, and they do have negotiating power if they know some of the things that you had mentioned here. They're gonna, I guess, in a lot of cases, like you're a founder, you built a company, you have a law degree. A lot of them don't, but I think founders have to learn how to become this jack of all trades, and especially when it comes to investor relationship, because this is the one that's going to be like a crucial relationship for the growth of their company. So thank you so much, Ben, for coming and giving these insights. This is one episode that I think is going to be really meaningful, and it's going to help a lot of founders in the process. So thank you.
Thank you so much for the opportunity to tell our story.
Okay, no problem. So for our audience, if you have topics you want us to explore, please email us at communications@altitudeaccelerator.ca. Tech Uncensored, it's powered and produced by Altitude Accelerator. We're hosted on Spotify, and you can find us wherever you get your podcasts. So until next time, my name is Hessie Jones. Please stay curious and be inspired.
All right. Bye-bye.